This week, Treasury yields rose and growth-sensitive stocks fell. The Nasdaq 100 lost about twice as much as the S&P 500.
But the key detail sits inside the curve. The 5-year yield rose more than the 10-year.
So this was not simply a story about higher rates. Different maturities test different horizons.
Our question is narrower. Did the week look like broad long-horizon risk, or a more concentrated repricing of the next several years? All market comparisons use completed hourly bars in this reporting window. The 5-year Treasury yield moved from about 4.371% to 4.424%. That is an increase of roughly 5.3 basis points. The 10-year yield moved from about 4.706% to 4.738%, an increase of roughly 3.2 basis points.
Both maturities rose, but the 5-year rose by more, roughly 2.1 basis points more than the 10-year.
That does not prove a single cause. It only describes the part of the curve that moved more in this completed window.
Equity prices supplied the second half of the tension. The Nasdaq 100 fell about 2.6%, while the S&P 500 fell about 1.3%.
The larger Nasdaq decline fits a familiar sensitivity. Companies whose cash flows are valued further into the future can react more strongly when discount rate assumptions become less comfortable.
But familiar is not the same as complete. The weekly relationship cannot tell us whether yields were the only driver. Earnings expectations, positioning, liquidity, and risk appetite can all move equity indexes at the same time.
The observed evidence is narrower. Yields rose across these two maturities, the 5-year move exceeded the 10-year move, and the Nasdaq 100 underperformed the broader S&P 500.
Why focus on this difference? The 5-year is closely tied to the expected policy rate path over the next few years. The 10-year adds a longer horizon risk premium. When the 5-year leads, the market can be revising the nearer policy path more aggressively than the longer horizon.
Consistent with is not equal to proven by. The term premium inside the 10-year yield is not directly observable, and neither maturity can be reduced to one news headline.
That is the key guardrail. The curve gives us a map of relative repricing, not a receipt listing one certain cause. The numbers also show why a headline-only explanation is too weak. The 10-year yield reached an observed low near 4.637% and a high near 4.746%. The 5-year ranged from about 4.318% to 4.430%.
Both markets moved through ranges before finishing higher. Treating the final weekly change as one instantaneous reaction would hide that path. TLT did not mirror the 10-year perfectly. That is why this experiment compares Treasury yields directly instead of using an ETF as a proxy.
For this episode, the cleaner comparison remains the 5-year and 10-year yields themselves.
Confirmation would be a continuing 5-year-led repricing. The intermediate part of the curve remains under more pressure than the 10-year, while the Nasdaq stays more sensitive than the broad index.
The invalidation case is reconvergence. If the 10-year begins moving more than the 5-year, the question shifts toward longer horizon inflation, growth, supply, or term premium concerns. If both yields retreat together while equities stabilize, this week's relationship may prove temporary.
Notice that these are structural checkpoints, not forecasts. We are watching which part of the curve carries the next move and whether equity sensitivity remains concentrated in the Nasdaq 100. Useful observed reference points are 4.424% on the 5-year, 4.738% on the 10-year, and the relative weekly losses of 2.6% for the Nasdaq 100 and 1.3% for the S&P 500. They are evidence markers, not targets.
Yields rose and stocks fell, but the curve adds a more specific message. The 5-year repriced more than the 10-year during this window.
That is not proof that the market solved the policy outlook. It is evidence that the near to medium horizon moved more than the long horizon this week.
The next experiment is to watch for persistence or reconvergence. Does the 5-year keep leading, does the 10-year take over, or do both move back together? We will track the 5-year, 10-year, and Nasdaq response in daily X updates. Follow MVL Lab on X for those checks, and subscribe to Market Validation Lab on YouTube for the full Weekend Lab series. Links are in the description.